Welcome back, Focus Learners. I am incredibly thrilled to have you here for another explainer. Look, today we're tackling a topic that, let's be honest, causes a lot of anxiety for people, and that is the stock market. But we're going to flip the script a bit. We're approaching it through the totally timeless, wealth-building philosophies of Benjamin Graham. You know, the guy widely considered the father of value investing? Okay, let's dive right into this and learn how to truly tame the chaos of the market.
I want you to start by just asking yourself this. How would you handle a business partner who is just completely irrational? I mean, imagine being in business with someone who is totally manic depressive, someone who constantly changes their mind about what your shared business is worth from one day to the exact next. It would be absolutely exhausting, right?
Well, guess what? You actually do have a partner exactly like that. Meet Mr. Market. This is an unpredictable, wild entity whose daily valuations swing wildly based on pure emotion. If you've ever felt anxious about market volatility, listen, your feelings are completely valid. But Graham's absolute genius was in reframing the stock market. He said, hey, it's not some perfect calculator of value, it's this highly irrational, emotional entity.
So, here is our roadmap for today's explainer. We'll formally meet Mr. Market, look at investing versus speculation, figure out your investor type, find true intrinsic value, build a margin of safety, and then wrap up with some timeless rules for wealth. Section 1. Meet Partner Mr. Market, the allegory of the stock market.
To succeed out there, we absolutely must understand the environment we're operating in. Back in his 1949 classic, The Intelligent Investor, Benjamin Graham introduced this concept of Mr. Market. He's an allegory meant to personify the irrationality and the groupthink of the stock market. Think of him as this incredibly obliging fellow who just turns up at your door every single day, offering to either buy your shares or sell you his shares, but always at a completely different price.
And notice how extreme his mood swings are. When Mr. Market is feeling very pessimistic, he panic sells at these ridiculous bottom-of-the-barrel lows. But when he is wildly optimistic, he engages in this euphoric buying at totally hyped-up highs. The crucial, absolutely vital point here is that the prices he quotes you are driven by his daily emotions. They are not driven by the actual underlying reality of the business.
And honestly, this brilliantly illustrates our ultimate superpower as investors. Just look at that steadfast lighthouse, taking hits from the crashing waves. As an investor, you are completely free to just ignore Mr. Market's stormy, ridiculous offers entirely. If you don't like his price today, you can just wait. He doesn't care. He will literally be back tomorrow with a totally different offer.
Moving on to Section 2, Investing versus Market Speculation, knowing the difference.
This right here is the critical mindset shift. It's what you need to survive Mr. Market's daily roller coaster without losing your mind. We have to draw a hard line between these two activities. True investing, that focuses on the operating performance, the dividends, the actual fundamentals of the business you own. Speculation, on the flip side, is really just trying to forecast and time short-term price movements. And the sources make this incredibly clear. There is absolutely zero evidence that market timing and forecasting actually work over the long haul.
Okay, Section 3, the two investor types. Pick your lane.
So once you actually commit to being a true investor rather than just a speculator, you got to choose a realistic path based on your actual lifestyle. Graham defined two main lanes. First, you've got the enterprising investor. This person commits heavy time and energy, treating investing almost like a full-time business operation. On the other side is the defensive investor. This approach requires very little effort in day-to-day portfolio management and focuses purely on conservative investments. Graham was pretty blunt about this. He noted that most people simply don't have the time to do deep, rigorous business analysis, so for sure, they should strictly follow a defensive strategy.
Section 4, finding true intrinsic value. What is it actually worth?
Now, you might be wondering, if we are completely ignoring Mr. Market's crazy prices, what anchor do we use? How do we not get swept up in the hype? Well, that anchor is intrinsic value. Basically, this is the estimated true worth of a company based on its actual assets, its earnings, and its future cash flows. And pay attention to the most important part of this definition. It is completely independent of its current stock price. Remember, price is just what Mr. Market is asking you to pay today. Value is what the company is actually worth.
So where does this value actually come from? A firm's value is essentially built from two sources. You have the investments the firm has already made, these are the assets currently in place, and then you have the expected future investments, which are its growth opportunities.
But how do we crunch the numbers to calculate this? Well, the most common method you'll see today is discounted cash flow, or DCF, that estimates future earnings. But here's the catch.
Even slight changes in your estimates can drastically alter the final output. Benjamin Graham? He was incredibly conservative. He preferred a much stricter standard called Net Current Asset Value, or NCAV. This looks strictly at cash and short-term assets, subtracts all liabilities, and completely ignores long-term assets like buildings or patents. It's a really hardcore standard designed to find stocks trading so cheap that they are practically valued for less than what you'd get if you just liquidated the whole company.
Which brings us to Section 5, building a margin of safety, the bridge analogy.
That incredibly conservative mindset that acts as your ultimate shield against a totally unpredictable future. Take a look at this huge number, 30,000. What does this represent? It's actually the structural capacity of a well-built bridge.
See, Graham absolutely loved to use this bridge analogy. Think about it. If you expect a bridge to carry a 10,000-pound truck, you don't build a bridge that maxes out at exactly 10,000 pounds. That'd be crazy. You build it to support 30,000 pounds. That extra 20,000-pound capacity, that is your margin of safety. In the stock market, you need this exact same financial buffer to absorb human error, bad luck, inaccurate forecasts, or just extreme market volatility.
I want to read this powerful quote directly from Graham because it just hits the nail on the head. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Wow. So the crucial point here is that by buying an asset at a price way below its intrinsic value, you protect your portfolio. Even if your growth estimates are totally wrong and the future yields just mediocre returns, that built-in buffer means you can still walk away with a profit.
Section 6, Timeless Rules for Wealth. Graham's Playbook.
Let's bring this whole shebang together and translate Graham's concepts into a real, actionable playbook for everyday retail investors like us. Step 1. Truly know the business before you invest in it. Step 2. Ignore Mr. Market's daily, manic-depressive emotional swings. Step 3. Always demand a margin of safety to protect against bad forecasts. And Step 4. Avoid market timing and strictly avoid the hype of initial public offerings, or IPOs. IPOs often bring massive hype without a deep track record to back it up, and true value investors know to look right past that trending hype to focus purely on underlying business value.
Now I hear you. You might be sitting there thinking, okay, this was written back in 1949. Does any of this actually still work today? The answer is a massive, resounding yes. Modern empirical studies confirm that Graham's strict asset value methods still identify huge winners today. Decades of data show that strictly following his conservative models continues to outperform the overall market. The math, quite simply, holds up.
Which leaves us with one final, kind of provocative question for you to consider on your own financial journey. Are you ready to stop listening to Mr. Market and start actually looking at the business? Because when you demand a margin of safety and outright refuse to play the speculation game, you take back control. Thank you so much for joining me for this explainer. Until next time, stay focused and keep learning.